At the beginning stage of September, we saw quite a lot of volatility in line with seasonal patterns. However, from mid-month onwards, we saw a strong recovery in the stock market amid a slew of good data releases better than expectations, as well as a 50 basis point rate cut by the Federal Reserve, which was well received by markets. As we head into the final stages of the year, we're moving into a much more seasonally favorable period where stock market returns have historically done particularly well. On the back of the 50 basis point rate cut from the Federal Reserve, we saw a number of projection changes take place. Chief among them is the fact that the unemployment rate has been lifted throughout the forecast horizon. And this is very much in line with what Jerome Powell was saying at the Jackson Hole speech, where he stated that labor market conditions have actually cooled from their overheated state. Hence the unsurprising lift to the unemployment rate outlook. On the back of this, we also see lower inflation and core inflation forecasts in the projection material for this year and next. And this likely allowed the federal funds rate path to be lowered compared to previous forecasts, which sets the tone for an easing cycle heading into next year. On the back of the low intended federal funds rate path, we see that the dispersion of forecasts by federal committee members is quite wide. Nevertheless, the median federal funds rate trajectory is still above what the market is pricing in terms of rate cuts going forward, especially heading into 2025. So we think the market is likely needed to price out some of those cuts to be closer to the Federal Reserve's own projections. And this will likely be in line because of the fact that we've seen better than expected data releases more recently, and that we assess labor market conditions to be relatively upbeat, at least by historical standards. If we assess the non-farm payroll employment numbers, we see that the sequentially additive nature of these numbers is less steep compared to what we have seen in previous years. And this is likely a desirable attribute for the Federal Reserve because of the fact that the economy is still adding jobs at a less steep pace, and that will likely put less pressure, if sustained, on nominal wages going forward. Moving away from non-farm payroll employment in the US toward the Eurozone, we saw that the Eurozone Central Bank cut rates by 25 basis points for the second time in the cycle, and there were also some forecast changes worth noting there. We saw that growth forecasts were down revised throughout the forecast horizon, and this is in line with hyper-frequency data being quite weak relative to what we have seen compared to market expectations, and the fact that we also saw core inflation forecasts lifted in some of the years throughout the forecast horizon. This is important because of the fact that the central bank will need to strike a fine balance between supporting the growth element within the Eurozone, as well as making sure that we do not have runaway inflation dynamics yet again. Moving over to Asian markets, we see that in Japan, the yen actually depreciated over the month because of the fact that it was affirmed that any further rate cuts at the next Monetary Policy Committee meeting are unlikely, given the fact that the yen appreciation in recent months has likely quelled upside risks to the inflation outlook. And this is particularly important in terms of future policy dynamics going forward, that the yen will be a factor in terms of the feed through to the overall level of inflation. We see that a new Prime Minister, Shigeru Ishiba, from the Liberal Democratic Party, has been elected effective from 1 October going forward. And we assess that the primary policy objective there is to lift tax revenues via a strong economy. Moving over to other Asian markets in China, for example, we see that a slew of prospective stimulus measures were announced to revitalize the economy. So this primarily includes easier monetary policy dynamics from various interest rate facilities, lowering the reserve requirement ratio even further, which actually frees up liquidity for small and large banks to be able to lend, and they introduced a new swap facility that can be accessed to increase access to liquidity in order to buy local stocks. As you can see, a lot of the high beta sectors like real estate and the consumer discretionary sector did relatively well over the month of September, as markets were emboldened by a lot of these announcements. And to end off, moving over to the United States to take a look at the presidential polling probabilities, we see that after the first debate between Donald Trump and Deputy President Kamala Harris, that there has been little changes in the prospective outlook for who is likely to win the November elections. Moreover, we also saw a second assassination attempt on Donald Trump prove to be unsuccessful, and this actually points towards rising tensions as we head to the November elections. This all comes on the back of a slowing but growing global economy in recent months, and that's likely caused some sectoral outperformance amongst defensive and interest rate sensitive sectors. However, if we take a look at more frequent data releases such as retail sales and industrial production figures outside the US alone, we see that there's an increased level of resiliency relative to what we've seen compared to market expectations. And if that is sustained, that may point toward an inflection in the global growth cycle.